Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. We have just released our monthly India Market Outlook titled Positioning for Higher Volatility. In this episode, we discuss a key question: how should investors position their investment in a post-election market backdrop? Just a brief recap. Indian equities saw the steepest decline since March 2020 and bond yields jumped higher after a weaker than expected performance of the Bharatiya Janata Party-led alliance at the latest general elections. While the National Democratic Alliance did manage to win 293 lower house seats out of a total 543, crossing the 272 mark for majority. The BJP's 240 seats, however, were much lower than the seats that it won in 2014 and 2019 elections. Markets recovered later in the week after pre-poll alliance partners in the NDA extended their support to Prime Minister Modi as the leader of the alliance, paving way for his return to office for a third time. Well, now that the election is out of the way, investors too face the question on the prospects of Indian assets going ahead. Now, to answer this, we looked at the election playbook over the past 3 decades, which offers a key insight. Coalition governments do not mean weaker growth. Over the past 33 years, India has had only 2 governments out of the 8 in 2014 and 19 where a single party won a majority. However, GDP growth has averaged over 6.1% year-on-year over this period. Further, the strength of the past governments appears to have limited impact on markets beyond the very short term. Over the government's full 5-year tenure in office, economic growth dynamics, policy choices, corporate earnings, and global factors have generally been more important drivers of equity markets' performance. The Nifty index delivered an average 15% return during the past 6 coalition regimes. That said, interim unstable coalitions have led to weak equities performance. In our view, India remains on a strong footing by these parameters based on its resilient post-pandemic recovery, improved macro stability, and strong corporate earnings performance. The upcoming annual budget for fiscal year 2025 will offer more insights on the government's policy priorities. Improved fiscal balance following the RBI's record INR 2.1 trillion dividend payout could help the government balance its growth aspiration through continued focus on infrastructure, increased support for rural growth and welfare spending without jeopardizing fiscal consolidation. This could aid policy efforts of the past decade that focused on bringing governance efficiency, rationalizing tax, boosting domestic manufacturing, and macro stability. In our view, this sets a strong base for robust growth momentum in the upcoming years and supports the 12-month outlook on Indian equities and bonds. We now have a preference for diversified asset allocation with a neutral across all major asset classes. Within equities, we maintain our overweight on large-cap equities, given our view that it offers a higher margin of safety in terms of earnings and valuations and stronger balance sheets to withstand tighter financial conditions. Post the recent surge, we see attractive risk-reward in bonds. We are overweight medium and long duration bonds given the outlook for policy rate cuts, improved international demand for onshore bonds following the inclusion in global bond indices, and lower government borrowing given the fiscal consolidation path and robust tax collection. That's it in this edition of the podcast. Do reach out to your relationship manager for a copy of our India Market Outlook. You could also find this on the SC Invest page at sc.com/in. If you enjoyed this podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.sc.com/in.